Hello there, ladies and gents, and welcome back to the channel. Today we're discussing how to replace your salary with passive dividend income. What if you could completely detach your income from your time? What if instead of trading 40 hours a week for a paycheck, you built an automated financial system that paid for your life while you slept? Today we are walking step by step through how to replace your salary using passive dividend income to build an unstoppable cash machine. Quick heads up before we dive into the math. This video is purely for educational and entertainment purposes. Investing involves real risk, including the possible loss of your principal and past performance, as well as it doesn't guarantee future results. Make sure to consult with a certified financial planner before making any major financial moves. Now let's get into the strategy. Let's be honest, quitting your job sounds incredible, but here's the cold, hard truth. You can't just walk away from your 9 to 5 job without a reliable cash machine ready to replace your paycheck. And no, we're not talking about day trading or gambling on volatile meme coins. That's just replacing a stressful job with an even more volatile one. We're talking about building a rock solid, predictable, cash flowing asset using two main pillars: exchange traded funds, ETFs, and systematic dividend growth. The ultimate goal here is simple: stop trading your limited time for hourly wages and let your capital pay your bill for your lifestyle. To make this work seamlessly, we rely on two core mechanisms working in tandem: diversified ETFs and the DRIP strategy. First of all, why ETFs? Because picking individual stocks is practically a full-time job of continuous research. ETFs solve this by instantly bundling hundreds of top-tier, reliable companies into a single asset, giving you immediate diversification. Second of all, we unlock our secret weapon, DRIP, which stands for Dividend Reinvestment Plan. Instead of taking your early dividend payouts and spending them on daily coffees, a drip automatically takes those cash rewards and uses them to buy more fractions of your ETF shares. Look at how this loop behaves. Stage 1 gives you more shares, which leads to Stage 2, higher payouts. Those higher payouts trigger Stage 3, buying even more shares. With this engine running, you aren't just saving money, you're literally cloning it. Let's look at the hard data to see exactly how powerful this is. Imagine you have a $100,000 initial investment growing over 15 years. If you keep it safe in a high yield savings account at 3%, you end up with just $156,000 safe, but your growth is incredibly minimal. A standard growth ETF at 8% gets you to $317,000, and a single growth stock at 9% gets you to $364,000. But look at the far right of the chart. The definite winner is the ETF with DRIP. Program activated, hitting a 10% total return to accumulate massive financial value of $418,000. This gap starkly highlights why reinvesting dividends is an absolute game changer. It dramatically amplifies your wealth over time without adding an extra penny out of your pocket. To construct this cash machine safely, you need a balanced five-pillar portfolio blueprint. We don't put all our eggs in one basket after all. First of all, we use U.S. dividend growers as our foundation for stable growth. Second, we added international equities to give us a strong geographic hedge across global markets. Third, we allocate to dividend aristocrats. These are elite S&P 500 companies that have successfully increased their dividend payouts for 25 or more consecutive years. Fourth, we sprinkle in mid-cap growth to capture the next industry giants early on while also boosting our growth. Finally, you may use covered calls to trade off some of that stability for a little more cash flow. This exact blend ensures that while some of your funds actively drive your portfolio value up, others are constantly dripping heavy monthly or quarterly cash premiums straight into your account. None of this math matters if you don't possess the right psychological framework. True financial independence isn't about perfectly timing the market. It's strictly about your time in the market. You need an ironclad discipline called ABB, always be buying. That means maintaining your fixed monthly contributions regardless of what the market cycle looks like. When the market hits an all-time high, you buy. When the market feels completely flat and boring, you buy. And when the media starts panicking because the market crashing, that is when you buy even faster. Economic downturns are not a valid signal to freeze up or sell out. They are a rare financial fire sale. A market correction is simply a golden opportunity to step up and aggressively buy high quality, income generating assets at a massive discount. When the market inevitably recovers, your dividend yield on cost skyrockets. At the end of the day, replacing your salary with dividends isn't an overnight get rich quick trick. It is a mathematical inevitability if you simply choose to stay consistent over the long term. Your action plan starting today is straightforward. Number one, start small with whatever you can afford right now. Number two, turn on your drip so your payouts compound automatically. Number three, diversify your assets using the 5 pillar blueprint we discussed. Number four, embrace the ABP discipline and never stop buying. It's time to stop working around the clock for your money. Start building an automated dividend portfolio that works around the clock for you. If you found value in this breakdown, make sure to smash that like button, subscribe to the channel, and I will see you in the next one.